Coming up on Kudlow and Company, Happy New Year, Goldilocks, or maybe not. Bad day for factories and stocks today, so who is going to defend Goldie's honor? Well, I am. Our all-star team will also weigh in. Plus, Fed to the rescue or not? Come on, you Fed folks, let's get moving. And does anybody really care about the Iowa caucuses? Well, let me tell you, if the winners happen to be Senator Edwards and Governor Huck, Wall Street's going to have a problem. And finally, does America need a temporary fiscal fix? No way. I say permanently slash the corporate tax rate. Our dynamic duo, Robert Reich and Steve Moore, will debate. In fact, I say capitalism and freedom in the new year. I am tanned, rested, and ready. We are money, politics, and stocks. That's our beat. Fasten your seatbelts, everybody. Kudlow and Company begins right now. Good evening, everyone. I'm Larry Kudlow. Welcome back to Kudlow and Company. We aim to be right on America, right on business, and right on the money. And yes, we still believe that free market capitalism is the best path to prosperity. On this evening's program, down stocks, down factories, gloom and doom, recessionistas. This is no way to start a new year. But, you know, today, business construction booming at a 20% rate. So take that, pessimist. Look, we have Don Luskin, Chief Investment Officer, Trend Macro. We have Michael Pansner, Wall Street trader and author of Financial Armageddon. We have Jim Swanson, first time on the show, Chief Investment Strategist, MFS Investment Management. It's a huge fund operation. And our pal Kevin Kerr, president of Kerr Trading and editor of Resource Trader Alert. All right. First up, it is not the subprime issue that worries me right now. It's the business, production, and supply side of the economy that is looking a bit sloppy. So let's go to Kudlow 101. All right, a lot of hoopla today over an unexpectedly weak factory report. The Institute of Supply Managers, they reported a 47% number. Now, two quick points on that. For the quarter as a whole, we're still just under 50, which isn't bad. And incidentally, in order to properly signal recession, this thing's got to fall much more down to 41 or 42. But this does raise a lot of issues. And in fact, we have seen a gradually slower pace for the factory report. All right, let's go down to the next chart. The root of all concern, not evil, but concern, is a slowdown in profits. Profits are the mother's milk of stock. Profits are the mother's milk of business and the economy. Now, we see for 2007, we're probably looking at only a 2% profits increase, and it has been getting slower and sloppier for the last several years if we trace the slowdown. Slower profits lead to some problems. It can lead to slower business advancement. It can lead to slower production. It can also lead to slower employment, and it is employment, of course, that supplies the income for consumer spending. Let's go to the next chart. I believe one of the issues is still that the Federal Reserve is excessively tight. Now, we're going to hear some disagreement about that from our great friend Don Luskin, but this remains my view. The yield curve is still inverted. That is to say, the Fed funds rate is higher than the other Treasury rates. That's been true now for 18 months. And I think it's starting to take its toll. If you can't borrow short and lend long profitably, well, guess what? You don't create any money. The adjusted monetary base, which is controlled by the Fed, has essentially stopped growing. It's down to 1.9% of all of 2007. And let me just say on this, one last point on money. Since the Fed started easing and putting in discount rate and liquidity in mid-August, the monetary base is actually turned negative. That is not a good sign. Now, with all that, I still defend Goldilocks because I think she's going to get through this sluggish period. Let us not forget one important, really interesting thing. The global stock market continues. And look at this. 2007. The world market capitalization, this from our friends at Carpe Diem, Professor Mark Perry of Michigan Business School, 2007, global stock market capitalization up another $9.5 trillion. So the global boom continues. We'll hear from Kevin Kerr on that in just a moment. And in fact, Pakistan, now listen to this, with all of its troubles, the Karachi Stock Exchange up almost 50% in 2007. So let's go to our distinguished panelists and parse through this. All right, let me first go to Armageddon. consistent as he always is, cheerful as he always is, Michael Pansner. I say Goldilocks will slow a little bit, but there's really nothing to worry about. What's your take?
Well, if you look backwards, Larry, I guess you'd have that perspective. But looking forwards, I think things are looking pretty ugly. In fact, I think what you saw today was the sort of warm-up act for the great reconnect, when stock prices finally catch up with reality on the ground in terms of the economy. And as far as I can tell, it's looking a lot like the top of a roller coaster.
Which connect is this? Remind me about this connect. I've sort of lost this connect.
Sure. You've got upheaval in the credit markets. You've got the consumer ailing and overstretched, essentially. You had a pretty terrible Christmas holiday. It looks like they're tapped out. And, 70% of the economy is backed by the consumer. And I think that is a sign of things to come.
All right. Don Luskin, I personally had an excellent Christmas holiday, and I hope you did too, and the rest of your family. Where does Armageddon Pansner get it wrong?
Well, what he calls the Great Reconnect is his wish that finally markets will downtick for a couple days and give him the momentary illusion that he's been right about all the success of pessimism. I mean, I have heard, it's literally, it's going on decades now that we've had to hear about the indebted consumer and the deficit and all this stuff. I mean, come on, it just doesn't wash. It never has any real impact. And housing, don't tell me about housing. The housing sector's been in contraction for 7 completed GDP quarters. Those 7 quarters have been the best 7 quarters cumulatively for the rest of the economy. So there's no problem here.
Hey, Don, how come nobody, this is so fascinating to me, all day long, there was a steady drumbeat about weak factories because the ISM came in a little bit below expectations. I haven't heard anybody, I don't think, talk about the boom in business construction, commercial construction. Listen to this. Private, non-residential construction, a.k.a. commercial construction, up 1.7% in November, 1.2% in September, 2.6% in September, 24.4% at an annual rate last 3 months, 20% over the past 12. Don Luskin, is that a recession, depression, pessimista, or Main Street? What is that?
No, it's ridiculous. I mean, you could tell the same story about exports. We've gained more per year in GDP terms, like $209 billion a year over the last 2 years in new exports. What have we lost in housing contraction? About $145 billion a year. And then add non-residential construction to that, you're almost at $300 billion a year. So this economy is growing great. But of course, the media and the people who are trying to aggrandize themselves on financial television shows are always just going to focus on the hot story, which is risk. Is that risk. You're going to lose all your money.
Is that like touting their own shorts, their own Perma-Bear shorts? Don't answer that. I don't want to incriminate anything.
No, I wouldn't say that.
Mr. Jim Swanson, MFS Investment Management. It's a huge fund operation. First time in the show. Welcome, Jim. Who's right?
Thank you.
Who's right, Don Luskin or Armageddon Pansner? Who's right?
Well, I'm more on Don's side here. I think we have some trouble ahead, though, and we've got 2 halves coming where earnings are going to be, as you mentioned, sloppy. The wolf's circling around Goldilocks' house, but Goldilocks reasserts itself in the second half. But we do have some problems, and I'll tell you what they are. They're jobs, and they are related to houses. I agree with you. This isn't subprime. This is a problem of too many empty houses. People are discounting the price of houses, and new builders aren't hiring the roofers, the contractors, the plumbers. And we're seeing this. The 3-month average of claims is starting to rise here.
Right.
We need new jobs.
Let me stop you there. This is a very important point. Let's put the housing and subprime aside, not because it isn't important, but because it is over-obsessed. It is totally over-obsessed. I want to come back to your point about profits, which I put on the Kudlow 101 scorecard tonight. When you get a slowing in earnings, that does, I think, lead, I hope you agree, or I think you'll agree, you'll get a slowdown in expansion, which can be a slowdown in production and employment. And it is those factors that cause consumer incomes to slow down. Now, how seriously should we take the profits issue? Profits are the mother's milk of stocks. Profits drive the free market capitalist economy. And we know overseas earnings are booming by 30 or 40%, but we also know domestic earnings are actually in the red. They're down below zero. What's your profits take? This is so important to stocks and the economy.
No, it is critical, and profits are going to come back, but you've got 2 quarters where everyone's going to throw the kitchen sink out with every problem they have, but several sectors are making money. Tech's making money. Healthcare's making money. Consumer staples is making money. So
Energy.
You've got the energy is making money. So it's going to become a more specific market. It's going to become more differentiated. And you've got to play the sectors more carefully. But remember this, profits as a share of GDP, 12 cents of every dollar is going to the owners of capital.
All-time high.
This is a 57-year record.
All-time high.
Or an all-time high.
Absolutely
and
fantastic.
That is, the year-over-year comparisons aren't as important as that. And that is still the fuel for jobs and wage increases in CapEx.
All right.
And that's going to keep us out of recession.
That is exceedingly well put. Well done. Very capitalistic. I enjoyed that. Now, Kevin Kerr, welcome back, buddy. Happy New Year.
Happy New Year.
Let me ask you, who cares about $100 oil? Who cares?
Well, let's flip this around, and I want to make a point. You know, the manufacturing number might have been a little negative. Like you said, it was only about 47%. It's got to drop more than that to be real concerning. Bottom line is, in the face of, we've had over $80 oil for a while now. Now we're here at 100. Exactly. Big deal. It hasn't affected this more. We should be seeing a much bigger drop if oil is really that big a factor.
I thought it was going to cause a recession, depression, or every time oil line. We've heard this, $60, $70, $80, $90. We're on the verge of $100. Recession, depression, end of the world. Kevin, are you sure? Are you sure? Maybe you should be much more pessimistic about this.
I am not pessimistic, Larry. As I told you before, I agree. This is a global growth story, not only in oil, but in the gold. We've seen it in the agricultural commodities, soft commodities. There's more demand globally for all of these things. That's an indicator that not only the U.S., and the U.S. might have to go through some bumpy time here. I agree. You know, I'm very concerned about employment. I want to see that number stay consistent and strong, and we need to see job growth. That's a concern. But, you know, overall, the global economy is solid. So, going forward, I'm very confident.
Actually, just one more for you. This is courtesy of Brother Pansner via the Barry Ritholtz Big Picture website. This is very interesting. A breakdown of the CRB futures subcomponents. Let's put that up on the board. I think we have that. And I believe, much to everybody's surprise, the biggest gainer last year, I mean, energy was pretty good, but I think the biggest gainer was grains. There it is. Look at that. Grains up 53%, energy up 40%. Precious metals up 26%, industrials 13%, and then livestock and soft commodities basically flat. The overall index up 17%. Now, this chart's original idea, its intellectual conception, if you will, comes from Armageddon Pansner. I want first you, Kevin Kerr, to comment on it.
Well, look, we saw agriculture surge last year for one big reason. We have bigger demand out of China and India. That's growth, bottom line. We had some weather problems this year.
Pakistan.
Oh, I'm sorry?
Pakistan.
Absolutely.
Grew 6.5% last year. The Karachi stock market was up 50%. That's just an aside. It's utterly irrelevant to this conversation. Please go on.
We saw the wheat and the soybean market rally limit up today because of Pakistan buying more grains. This is not ending, it's just beginning. In fact, I think we're at the beginning of this cycle, especially for the agriculture markets and the rest of the commodities as well. This, again, it's a growth story that's just not ending.
Armageddon Pansner, your own analysis, your brilliant concept of breaking down the CRB futures, which allowed me to create this incredible, informative, illuminative chart, says a world boom is going on. That is exactly what Luskin is saying. Defend yourself and your bearishness.
I don't know. It's hard to think about trading here, Larry, when people keep looking backwards. I mean, if you're extrapolating out on all these trends, that's great, but I don't think that's reality. And to a certain extent, you had weather-related issues with the agricultural products. You did have some... obviously some feedback from the growth that's been taking place in emerging markets, but it's all part of this last speculative fling. You know, it's like the last little remnant of gas in the gas tank. Pop, we go, and then it's all over.
But you know, Michael Panzer, the last dance is always the best dance. It's
That's
always
true,
the best
Larry.
dance. It's
At my
cheek
age,
to
I
cheek.
appreciate that,
It's
yeah.
tight bodies put together. The last dance is always the most fabulous dance. What's wrong with you?
I guess I'm just too many gray hairs here, Larry, and all I can see is problems as far as the eye can see. And I have to say I feel particularly good today because I've got 4 bulls against me, so it makes me feel that warm and fuzzy part of my...
I know, but we're using your own charts. That's the way. That's the great equalizer. We're hoisting you on your own 4 little petards there. All right, on the way out, quick summarization, summarization, whatever. Don Luskin, what do you make of the commodity story and the world boom story and And let me ask you, is inflation still uppermost in your mind?
Well, absolutely. I can't believe that word hasn't come up until this point in the show. You know, I'm taking a victory lap here. We have gold at all-time highs today, all-time highs. That is all about inflation. That's not all about global growth. It's not because people in Pakistan suddenly have a new appetite for Rolexes. It's because of inflation with a capital I, and that underlies a lot of the themes we've got here. Now, inflation is the price we're paying for the Fed bailing this economy out of some of the problems that it has and some of the problems that it doesn't
So
even
are you
have.
still buying? You playing it from the bull side in the new year 2008?
I am, but I am, you know, why not be smart about it? I'm focusing on metals, materials. I'm short the dollar. And we had a bad day in the market today. The energy sector was up.
Jim Swanson, what about the possibility, A, that the gold boom, the commodity boom, is in fact about the world global boom, as Kevin Kerr has suggested, including Pakistan? I'm putting that in because I still think there's hope for Pakistan. And B, what about the geopolitical terrorism, war risks? A lot of people have done some interesting work. Some supply-siders have said it's really the geopolitical risk that is driving gold and oil higher. What's your take, Jim? This has been a vigorous debate for a couple of years on this program. Where do you come out?
I come out on the oil very much so. It's geopolitical. It's not driven by supply-demand. The supply-demand equation, you know, filters out 60 to 70 bucks. You know, the best way to get at that is look at the price of these big integrated oil companies and look at the implied price of oil that's embedded in those stock prices. And it's around 60, 70 bucks.
What about Mr.
Not 100.
Luskin's inflation worry?
Oh, well, I think inflation is creeping up. I have no doubt in my mind that's what's happening.
Creeping or galloping? Creeping or galloping?
It's creeping up. It's creeping up. With an economy slowing, you're not going to get the gallop, but it's there for sure. I agree with that.
Good. Luskin found an ally. He found an ally.
Large cap stocks and tips are a good combo.
He found an ally. Kevin Kerr, you think inflation's going to creep up or gallop up or go up? Because I'm afraid I don't agree. But what's your take?
Look, we have to pay a close attention to it if we see it start to creep up. I don't think so. You know, Larry, look at that adjusted chart for the adjusted inflation chart for gold. We're at $860. It really should be at about $2,100.
Yeah.
I think it was on with you about a month ago, $1,600. Now it's $2,100. We're not even halfway there.
All right. Happy New Year, Kevin Kerr. The rest of our panel is going to stay. One thing I want to ask, I'm not really crazed about the Iowa caucuses. I think it's kind of boring. But I will say this. If Huck and Edwards should come out victors in tomorrow's caucuses, they both hate Wall Street. I want to find out what our panel thinks about that. Coming up, a Fed fight. We have two former Fed bigwigs, Wayne Angel and Bob McTeer, plus our Kudlow All-Stars, Art Laffer and Brian Westbury, to help push the Fed in the right direction. And as I said, who cares about Iowa? I want to have our panel, our stock market panel, is going to talk about this. And finally, the right stimulus. Washington's getting ready for recession. We're going to talk tax and spend, tax cuts. Hey, how about a permanent reduction in the corporate tax? How about a little